Hello everyone and welcome to the first chapter. We are going to discuss insurance in great detail in this course. So we are going to begin with basics of insurance and proceed from there. Okay. So I'll read through and explain as the concepts come in. So what is insurance? Insurance involves a protective measure where a contract binds one party to indemnify another party in return for sum of money, often referred to as insurance premium. So let's unpack this. So what is insurance? Insurance says you pay a small premium to an insurance company who agrees to pay you, right, in case some catastrophe happens. So let's take an example of a car insurance and let's unpack it a bit more. So what is a car insurance? You're driving a car, right? The car can be damaged or you can cause damage to someone else when you're driving your own car. So what do? You pay premium to an insurance company, an auto insurance company, and the auto insurance company agrees that if there is an accident, they will pay all the cost or some of the cost associated with the damage. So this is the basic concept of insurance. What does the word indemnify means? Indemnify means to pay, right, to make whole. The basic concept is to make whole. Make whole means, right, to cover the losses. So what is a contract? A contract is a legally enforceable agreement between two or more parties, and the term offer and acceptance are basic two elements of a contract. So in an insurance contract, right, which is legally enforceable, it means you can take that contract to the courts, and if you fulfill all the conditions of the contract, the insurance company has to legally pay you the sum. So it's between the two parties, and the term offer and acceptance are two basic elements of an contract. So in an insurance contract, when you are enrolling into an insurance contract, you usually provide an offer to an insurance company that this is my profile, this is my risk, I am offering you this premium to cover that risk for me. Now the insurance company has to accept that risk, accept you as a insurance person, insurable person. So these are basic terms, offer and acceptance, that are involved in insurance. If the agreement is enforceable by law, there must be a consideration, that is, there has to be money involved. So you need to pay a premium, right? The parties must have legal capacity to enter into a contract, that is, you need to be of sound mind and of legal age to get into a contract. The parties must have capacity to contract, and there must be legal intention by both parties to enter into contract. So the contract cannot be forced on you. You must be willing to get into the contract. So this was the basic contract framework. Let's understand insurance contract in a little bit more detail. A contract of insurance is similar to a regular contract, but some aspects are specifically unique to insurance contract. The offer and acceptance of insurance contract and consideration. The offer and acceptance of insurance. What does that mean? The completion of an insurance contract by an individual is generally considered as an offer, where an individual becomes the offerer. So what does this mean? So any insurance you take, life insurance, auto insurance, home insurance, they will give you a form which you have to fill in, right? It provides detail about your profile, right? It provides details about the risk you are trying to cover, right? For example, if it is a car, you need to mention the make, the model, the year, your driving habits, right? Your, like, how long have you been a licensed driver? All these things you have to mention. So when you fill out that form and give it to an insurance company, that is considered to be an offer, and that offer has to be accepted by the insurance company. Then there is a consideration. Payment of insurance premium by a policy owner is the consideration from one party, whereas the contract itself becomes the consideration put forth by the insurance carrier. So considerations have two sides. One is you pay regular premium to insurance company. That is your consideration. And the insurance company agrees to pay in case some damage happens. That is their consideration. Then there are parties. There is an applicant. Who is an applicant? The individual who completes the application for the insurance and wishes to be the owner of the insurance contract becomes a party to the potential contract. At the time the contract becomes effective, in most situations, the policy owner must have an insurable interest, otherwise the contract is considered void. So we have to unpack this a bit. In an insurance contract, there has to be an insurable interest. What does that mean? You need to suffer loss if something happens in order to get an insurance. So you will suffer loss if something happens to your own self. So you have an insurable interest in your own self. You have an insurable interest in your spouse, because if something happens to the spouse, then you may suffer financial losses. So in that case also you can do a contract, an insurance contract on your spouse's name. Okay, you have insurable interest in your own car, you have insurable interest in your family car, but you cannot have insurable interest in your neighbor's car. So you cannot do insurance for your neighbor, right? Neighbor's car. With property and casualty insurance, generally the only person who can acquire insurance coverage who is the person who owns the property. Insurance carrier is the party who accepts the applicant's offer. Contract formation happens when you pay a premium. So premium payment is necessary. A policy, even if it is issued exactly as requested by the applicant, can only come into effect by delivery of the policy to the policy owner along with collection of first premium. Unless and until you pay premium, the insurance contract is not confirmed. So there are certain principles in insurance contract. There is the concept of insurable interest. To discourage financial gains through speculation, the law requires that an individual has an insurable interest before a contract of an insurance can be issued and be a valid contract. The requirement of insurable interest is required for life insurance contract only at the time the contract is issued, subsequent to which the ownership of the policy may be transferred at will without any requirement of an insurable interest. So what does insurable interest means? You need to suffer loss. Insurable interest concept means whoever you are insuring or whatever you are insuring, you need to suffer financial loss if something happens to that person or that thing. Principle of indemnity. The concept of indemnification is one where an individual is compensated for a specific loss with no possibility of profiting from the loss. This is a core principle of insurance. You cannot benefit from an insurance contract, right? This is what the entire insurance the concept is based on, that people should not be able to benefit from an insurance policy. You can make whole, that is whatever loss you have suffered, you can make it whole, but you should not be able to benefit from an insurance contract. Okay, so that's the first concept. Then we are going into risk management. So what is risk management? Whatever risk you have as a person, or if you own something, there are ways of handling that risk. Okay, what is risk now? Risk is something bad happening to you or your financial interest or the things that you own. Something bad, that is, you suffer a loss. Okay, so there is a risk management process. So the first step of a risk management process is setting risk management objectives. What are the objectives for our risk management process? Second is identifying and evaluating a risk, right? So if a person comes to you as a client and you're an insurance planner, you will note down all the risks the person faces. So that risk could be, right, that his life, if something happens to his life his family gets impacted. Then if something happens to his health, he's not able to work, that is disability, he and his family gets impacted. Then if something happens to his car, then the person gets impacted again financially. So this is the process of identifying risk. You need to note down all the risks that the person might be facing. Then we have to select strategies to handle that risk. We are going to discuss what different strategies are. It can be self-insurance, it can be taking an insurance policy, it can be avoiding the risk, it can be managing the risk, etc. Then it is implementing the risk management strategy, and finally monitoring it. So step 1, setting the risk management objective. The first step in understanding the risk management process is to identify the objectives that form the basis for the process that is being undertaken. So example that they have given, ensure a family has sufficient financial resources for X period of time in the event of a premature death of one or both spouses, right? If you have financial dependent, this becomes very crucial, right? That your family is taken care of if something happens to you. Step 2, identifying and evaluating risk. The next step is to identify risks that may impose financial losses as they relate to specifically objectives. So identifying what different kinds of risk you face. The severity of consequences arising from a potential outcome associated with a potential event are classified into 3 types. There could be a dire outcome, right? So catastrophic, like death is catastrophic. It could be substantial, like losing, let's say losing a car. It could be substantial. It's not dire, but it's substantial. Or it could be minor, like fender benders, right? You're parked, something like someone scratches your car, paint is like there is a minor fender bender, nothing major, right? So those are minor risk. The step number 3 is selecting strategies. So step number 3 involves considering and selecting strategies to address the specific risk that has been identified. So there are risk control strategies. These strategies are intended to reduce the probability of risk occurring or reducing the severity of consequence that could result from a potential risk, and have 2 classifications: risk reduction and risk avoidance. So how do you control risk that you face? You can reduce it or you can avoid it. Example of risk reduction. So if you're driving a car, you can have seat belts, you can have the driver assist system, the self-driving system, right? In order to protect yourself. So there is forward collision detection, there is like lane departure warnings, there is like blind spot monitoring. All of these technologies are available in the newer cars. So this is a way of reducing your risk of facing a major accident. The second risk control strategy is risk avoidance. So what is risk avoidance? Risk avoidance means that you do not drive at all. So if you don't drive a car, then the risk of facing an accident goes down. So risk avoidance is nothing but not driving a car. Then there are risk financing strategies. Risk financing involves strategies that assist in managing the cost associated with occurrence of a particular risk, and it involves risk transfer or sharing or risk retention. So either you can control the risk or you can finance the risk. Finance risk means you can transfer the risk to someone else. Insurance is a risk transfer mechanism, right? So you pay a small premium and you transfer the risk to an insurance company, right, against that premium. So if something bad happens, if you are in an accident, then the insurance company pays you off. Then there is risk retention. Risk retention is you do not transfer the risk, you take the risk on yourself. So if you meet with an accident and something happens to the car, then you have financial capacity to repair the car. In that case, you will not take insurance. Step 4 of risk management process is implementing. So the financial planner has a professional responsibility to assist the client in scheduling the necessary step and to work with the client and others as needed to ensure the implementation of the plan. So we implement the risk management plan that we have come up with. Step 5 is things change all the time. So you need to monitor the risk management plan. Since an individual circumstances and marketplace products and informations are constantly changing, a plan must be reviewed and updated regularly with the financial planner documenting discussions and decisions made by the client. So this was the risk management process. Now we are going to start with first one, property and casualty insurance. So first part among that is automobile insurance. So imagine you're driving a car. So what are the risks that you face? The first risk is you get into an accident and you cause damage to someone else. That is called as the third party liability that you have when you drive a car. Once again, what is third party liability? You're driving a car, you cause damage to someone else. It could be damage to his or her, like someone else's, like life, health, property. That is third party liability. Then you're driving a car, you can cause damage to, right, the car itself, right? So the damage could be due to collision, or it could be someone stealing your car. So there is collision aspect to insurance, automobile insurance, and there is comprehensive insurance that covers the car in case there is damage apart from collision. So this is the second tier of risk, causing damage to your car. Third is you can cause damage to yourself, right, or you can cause damage to your passengers, right, because of getting into an accident. So that is the accidental coverage. So something happens due to accident and there is physical damage to yourself or your passengers. So automobile insurance is three tiered. The first tier is causing damage to third parties. Second tier is causing damage to yours, like your car. Third is causing damage to yourself or your passengers. So let's understand and read through the entire auto insurance side. A much more complex than home insurance, since in each province and territory specified levels and various types of coverage are mandatory. There are phrases and terms used in automobile insurance contract that sometimes have specific meanings and include legal liability. Legal liability means when you're driving a car, you have a liability that you can cause damage to someone else, and that if you are at fault, then it is you have to pay the legal bills. You pay the, like, if someone sues you and it is proven that you are at fault, then you have to pay that person off. You can have negligence involved. You're driving, you are negligent. Negligent is a prudent person should take care of things, but you were not able to do that. For example, not stopping at a stop sign, that is a negligent behavior, right? So that can happen in an automobile insurance. Then there is the named insurer, policy owner. Then there is third party, right, not a party to an insurance contract. Then absolute liability, for example, suspended license driver injures a pedestrian. In that case, there is like absolute liability. You can determine that the person did not have a license and they caused a damage to a pedestrian, so that is a fault insurance. Then there is no fault, that things happen, right? You were driving, some black ice was there, the car skidded and you hit someone else. Now it was not your fault, but still the accident happened. And then there is deductible. Deductible is your share in case the insurance claim arises. So automobile insurance have very high provincial regulation. Each province has set of rules that automobile insurance companies have to follow. So automobile insurance laws are established at provincial level, with each province and territory legislating its own minimum standards as to type and amount of insurance each automobile owner must have to legally operate a vehicle. While each province have different rules and regulations, common principles prevail. Now there is bodily injury. Bodily injury, the first part is accidental benefit. So coverage for accidental benefit provides compensation to the insured and his passengers and to pedestrians should any of these individuals die or become injured in an automobile collision. So accidental benefit means you yourself, your passengers and pedestrians who are walking on the road are covered in case damage happens to them. Accidental benefit coverage includes medical treatment, including reimbursement for medical cost if not covered by any medical, surgical, dental or hospital plan, and various rehabilitation cost. It also includes payments towards funeral, right, for those killed in automobile accident. It includes a weekly disability benefit based on prior income, employment, degree of disability, although the design differs, right, among provinces, and payment following death of an insured person, where the amount depends on age, marital status, and number of dependents. Then there is an uninsured motorist aspect of a policy. While the bodily injury coverage under the uninsured motorist benefit is available in all provinces, an uninsured motorist still faces the possibility of criminal charges and is liable for costs associated with at-fault accident. So let's unpack this a bit. What is uninsured motorist? You're driving your car, you are in an accident, right, with someone else. Now that someone else, right, does not have any insurance, so that becomes an uninsured motorist. In that case, that uninsured motorist is legally liable for whatever loss that you have suffered, right? So that's the concept of uninsured motorist. Liability, there is third party liability coverage. So it covers the policy owner if his vehicle injures another party or damages that person's property and the policy owner is found to be liable. So third party liability coverage means you're driving the car, you cause damage to someone else, right? Someone else's property, life or health, and you are at fault. You are found to be liable. If the resulting claim exceeds the insured's level of coverage, the motorist can be held personally liable for the shortfall. This is very important. It's important to get a very high amount of third-party liability, because let's say you have a third-party liability coverage of 200,000, right? That is the bare minimum you can get in Alberta. But if the person who you have caused damage to sues you for $1 million and the courts agree to that, like lawsuit, means $1 million is awarded to him, the insurance company will only pay $200,000. Rest of it you have to cover. So in case you do not have enough third party liability coverage, you have to pay from your own pocket. So that can be quite damaging. Now, sometimes what happens, you're driving another person's automobile. So you borrowed the car from your friend, right? Or you're driving like a rental car. The term temporary substitute automobile is used when an insured drives another person's car. In the event of accident, the insurance policy of the owner of the substitute vehicle is first in line to respond to any claims. So when you give your car to someone else to drive, maybe your friend, you need to remember that if a claim arises, your insurance policy will be first in line to address that claim. Then there is damage to vehicles, right? It could be due to collision. Collision is impact, anything having an impact with your car. This indemnifies the policy owner for losses that result when a policy owner's vehicle is damaged due to collision. The owners of the vehicle valued at low amounts may decide that the benefit of collision insurance does not warranty the relative high cost. Now collision coverage is for your own vehicle, it's not for someone else. So collision coverage means you meet with an accident and something happens to your car. Collision, due to banging, right? Now if you are owning a car of $3,000, you may decide that anyways if accident happens, the car itself is valued at 3,000. So paying high premiums to get collision coverage is not for you. Comprehensive insurance. This covers losses or damage to an uninsured automobile resulting from variety of other causes such as fire, theft, vandalism, glass breakage, and other things that are not covered under collision insurance. So comprehensive means apart from collision, you are covered for other mishaps. For example, like hail damage or someone stealing your car, right? Those things are not covered under collision coverage. So if you get a policy with only collision coverage and someone steals your car, that thing will not be covered, right? If you get a comprehensive policy, then someone stealing your car is also covered. Other variations of automobile insurance include all perils and specified perils. So you can get an insurance policy with all perils, means anything happens they cover you except exclusions mentioned in an all peril policy, or there are specific peril policies in which only specific things that are mentioned in the insurance contract, only those get covered. Features. A variety of features can be incorporated in the design of an automobile insurance policy, and it includes waiver of depreciation. Waiver of depreciation means the moment you drive a car from a lot, let's say it's a new car worth $40,000, it starts depreciating. It starts going down in value. So if a claim arises and 1 year has passed, that $40,000 car is now worth only $36,000. Right, so the insurance policy is only going to pay $36,000 instead of $40,000. But you can get a waiver of depreciation rider. Rider is an add-on. If you have this waiver of depreciation, they will pay you the whole amount. They will not deduct depreciation from it. Also, it can have loss of use. You can loss of use means the insurance policy cover rental cars for small amount of time that you might have to use. Now premiums. Automobile insurance premiums are established based on series of factors that reflect the degree of risk associated with a situation. So premiums depend on the make of the car, the model of the car, the cost of the car, how expensive it is to repair the car. It also depends on your driving behavior, your driving history, sex also. Like women have lower premium than men. Men get into more accidents than women. So women have a lower premium. Consideration in the role of driver plays in the premium assessment, including location, which location you are in. Sometimes there are locations where there are more accidents, so in that, or more theft, in that case the insurance cost will be higher. Geographic region in which the insured vehicles will be driven on a regular basis. Driving in the city is more risky than driving in rural areas. The driving experience, driving record, age, sex, marital status of those who will be driving the vehicle, either as primary or secondary driver, and how the car will be used. If you're using it for business, right, then the cost is higher. If you're using it as a second car, right, just for groceries and stuff, the premiums will be lower. Then vehicle also plays a part in insurance premium. Factors specific to vehicle that is to be insured are reflected in setting of premiums. These include the total value of the vehicle to be insured, the repairs and replacement costs, the type of vehicle including make and model, right? The sportier cars are generally considered riskier and therefore result in higher premium. Policy design. The design of an insured automobile policy will affect the cost of insurance, right? Selected. The component of policy are insurance deductible, liability coverage, and collision coverage. We are going to cover deductibles a little bit in more detail, but what is a deductible? Deductible is your share if a claim arises. So let's say you have a $2,000 deductible. What does that mean? If you put any claim to the insurance company, let's say the claim is for $5,000 of damage, then $2,000 out of that you're going to pay. $3,000 the insurance company is going to pay. So insurance deductible is your share in the insurance claim. Then liability coverage, how much liability coverage are you getting, how much collision coverage are you getting, all this will determine your premium. Now in an insurance contract, especially in automobile, there would be a claim. So what is a claim? An automobile accident must be reported to the insurance carrier, right, where the insured plans to make a claim of benefit under the policy, or whereby the law the accident must be reported to police. So in case you have to report the accident to police, then you have to make the claim to the insurance carrier. You have to notify the insurance carrier. Should the damage exceed a minimum level as established by law, or if death or physical injury is involved, the police will also needs to be notified. There are set timelines for such things as notifying the insurance company of an accident and when the claims are made. If the repair makes the vehicle significantly better than it was prior to the accident, the insured may have to contribute the cost of betterment. So this is an important thing. So let's say your vehicle was already damaged and you did not report to the insurance company, and then it met with an accident, and the insurance company had to make the vehicle good as new. Then the damage that was already there, right, before the accident, you have to pay for that. Okay, so that covers the first part of insurance. We covered like automobile insurance in a bit of detail. Then in the second part we'll start with home insurance.